Hi, my name's Chris,
I'm Am.
I'm Reese.
I'm Courtney.
I'm Jasmine.
and we are
The Justice League!
Today we'll be discussing the case of Loan Shark Limited and Money Lending Incorporated. For a brief agenda, we'll first be discussing the accounting issues facing the company. In addition, we'll be discussing the operational and control issues, and finally, we will be giving a valuation to the company as of today.
Thank you, Chris. Now we are going to discuss the legal implications of LSL's current policy of charging a 20% interest rate on its financial products. The effective annual interest rate of their main product is 11,347.5%, which is in violation of Section 347 of the Criminal Code of Canada, which limits interest rates to 60% per year. Additionally, it's unclear if this charge is actually interest since it doesn't accrue over time, and a survey of its major competitors show that they charge processing fees in lieu of interest. We recommend that LSL charges a processing fee for their credit checks in the amount of 20% of the loan value. Our next consideration is revenue recognition. LSL's current policy is to recognize the total value of the loan as revenue. However, International Accounting Standards 18.7 define revenue as the inflow of economic benefits during the reporting period. A return of principal causes no net increase in shareholders' equity, which fails to meet this definition of economic benefit. We recommend that LSL adjust revenue and expenses down by $2,300,533 to better reflect the economic reality in which it operates. Up next is Courtney, who will discuss the provision for bad debts. Take it away, Courtney.
Thank you, Reese. Now, for another accounting issue, we discovered that the company is not making provisions for loan losses. As of March 12, 2014, 50% of the outstanding payday loans were in default. At the same time, the company recognized revenue of approximately $89,000 from the collections of loans that were previously written off in 2011 and 2012. As per conversations with Martha Matthew, approximately 30% of loans go into default, and 60% of these loans will never be collected. Accordingly, the company should make a provision of 18%, or just over $192,000. Rather than recognizing the $89,000 as revenue, the company should treat the collections as a reversal, which would ultimately lead to a bad debt expense of approximately $103,000. This bad debt expense should be recognized on the income statement. In order to enrich operations, the company should enforce penalties for late repayment. Now, on to the control issues we discovered. For the first control issue, we discovered one employee who has systematically sidestepped the controls currently in place. The employee has a large base of customers who exhibit strange behavior and only want to deal with him. Further, most of these customers have identical information, including their bank account numbers. Interestingly, 70% of his loans go into default, compared to the company average of only 30%. However, a surprising 80% of the defaulted loans are eventually collected, compared to a company average of only 40%. This could indicate fraud, as the employee may be fraudulently rolling these loans into his own bank account or using the system to launder money. Ultimately, we recommend that the supervisor cautiously monitors this employee and investigates this large base of customers. Further, the company should require sign-off from the supervisor on all documentation at the end of the day to avoid similar situations going forward. Now, back to Chris for some more control issues.
Thank you, Courtney. A major issue that we have identified in LSL's current operations is their client verification process. Currently, LSL uses the client's last pay stub to calculate the amount of the advance payment. However, if the client had worked significant overtime hours, the last pay stub may not be reflective of actual income levels. Therefore, a client may be able to inflate their advance payments by working extra hours. As such, we propose that LSL calculates the advance payment based on the average of the client's last 4 pay stubs. Another problem that we recognized was that LSL has a policy to verify employment before approving any loan. However, they often make exceptions when the employer is unable to be contacted at the time of the approval process. For example, a client may come into an LSL office in the evening hours to get a payday advance. In this case, it is likely that the CSRs may not be able to contact the employer, as this would take place outside of normal business hours. Without a sufficient policy, the CSR would approve the loan without verifying employment. If this catches on, clients may purposely come into the office in the evening in order to bypass the employment verification system. Our recommendation is that LSL should not approve loans without being able to confirm employment under any circumstances. This will reduce the risk of their clients defaulting on payments. The last issue in regards to the client verification process is that employees are not verified that the references provided by clients are legitimate. This means that the client could easily provide fake references with little consequences. If the client was to default on the payment, it is unlikely that the collections agency would be able to recover the payment if the references are illegitimate. As a simple solution, we suggest that LSL verifies the client's references as well. And we'll now discuss the control issues further.
Another issue that Loan Sharks has is their staffing issue. Currently, they have high employee turnover, and this usually tends to mean that there is something wrong in the workplace. Thus, it's recommended that Loan Sharks implement a more practical training program so that staff are not leaving, and therefore new employees do not have to continuously be trained. The next staffing issue at Loan Sharks is that they don't investigate employees before they are hired. This impacts Loan Sharks because these employees that they don't investigate are the same employees who go on to work with thousands of dollars of cash on a daily basis. Therefore, it is recommended that Loan Sharks implement a training program to assist the employees on procedures of how to deal with cash. In addition to this, it's imperative that Loan Sharks check references before hiring. Moving forward, Loan Sharks has a few overall control issues as well. Jacobs hasn't recorded any bad debts this year. However, a recent recession has taken place and accounts receivable are at an all-time high. Thus, we recommend that Loan Sharks record the bad debt since it is highly likely that it will not be collected. Another overall control issue is the fact that Loan Sharks usually receives numerous advances that are well over $1,500 within the period of a week. However, the supervisor has not seen a single advance for over $1,500 in the last 3 weeks. Therefore, this means that employees are not likely getting their checks verified and approved by the supervisor. Therefore, it's recommended that the supervisor do random audits on the employees to ensure that they are not bypassing the verification and approval control. Now that the audit issues have been addressed, I will pass it off to Jasmine to discuss the valuation of Loan Sharks.
Thank you, Em. Loan Shark Limited is currently deciding between selling their franchise rights and accounts receivable either back to MLI or to a third party. Under the first option, if Loan Shark were to sell to MLI, they would receive 50% of the prior year revenue and 60% of the accounts receivable to date. These amounts need to be adjusted and recalculated using international financial reporting standards. Revenue is calculated by removing the payday advance amount of $2,300,000 from the original revenue amount. Accounts receivable is calculated by deducting bad debt expense reduced by the total amounts previously written off for 2011 and 2012. As shown in column 4, Loan Shark has an adjusted balance of $460,000 for revenue and $967,000 for accounts receivable. When these adjusted amounts are recalculated using 50% of revenue and 60% of accounts receivable, they come to $230,000 and $580,000 respectively, to create a total selling price of $810,000. This is the amount that would be received if Loan Shark were to sell to MLI. Under the second option, if Loan Shark were to sell to a third party, they would receive approximately 10 times their normalized after-tax earnings. On the current income statement, after-tax earnings are reported as $244,000. On the adjusted income statement, after-tax earnings total $46,521. 10 times the normalized earnings of Loan Shark totals $460,000. This is the amount that would be received if Loan Shark were to sell to a third party. In summary, Loan Shark Limited would receive $350,079 higher return by selling their accounts receivable and franchise rights back to MLI opposed to selling to a third party.
This concludes our presentation, and thank you for watching
The Justice League!